Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Qualcomm.
If you find our talks useful, please consider subscribe, like, and comment underneath our videos. Also, a quick note, we use StockOracle for our research, and you can find a 14-day trial link in the description. Just a quick affiliate disclosure, we do get a small commission if you sign up. And please remember, AI insights and value estimates from any tool can be wrong, so always verify the data yourself.
Yeah, that is so important to keep in mind, especially with the company we're looking at today, because Qualcomm is going through this massive, almost existential identity crisis right now.
It really is, and as a value-focused investor, the setup here is just, well, fascinating. You have a company generating a massive 33.5% return on equity.
Which is incredible. They are exceptionally efficient with shareholder capital.
Right. They're absolutely printing cash from a dominant market position, but Wall Street is treating it like a toxic asset. They've aggressively wiped nearly 40% off its stock price.
Yeah, it's brutal. It recently closed at $161.91.
Exactly. That's a staggering 37.7% drop from its 52-week high of around $206. So our mission today, looking through this August 2026 equity research report, is to unpack this disconnect.
Right, because on paper, if you look strictly at the fundamental valuation metrics, the stock looks wildly undervalued. It's trading at a PEG ratio of 0.6.
And for anyone listening, anything under 1.0 traditionally suggests the stock is cheap relative to its expected growth.
Exactly. So combine that 0.60 with the 33.5% return on equity, and normally you'd see a stock breaking all-time highs, not catching a falling knife.
So we need to separate the real structural risks from the long-term growth drivers here. Is this a classic value trap, or is this a brilliant entry point to build long-term wealth?
Well, to figure out where Qualcomm is going, we first have to understand what it's running away from, and that is the smartphone market.
Yeah, the legacy handset business is bleeding right now.
It really is. The report shows handset revenue falling 20% year over year.
And I always say, in the tech world, a 20% drop in your core existing engine usually means the structural foundations are cracking. It's not a temporary blip.
No, the foundation is absolutely shifting. And that crack has a very specific name in the market, the Apple cliff.
Ah, yes, the Apple cliff.
It's the single heaviest weight dragging down the stock right now. The projections indicate that after September 2026, Qualcomm could see a staggering 50% revenue drop in its Apple modem stream.
Which is a massive hole in the balance sheet.
Massive. Apple has been working for years to insource its modems, and the market is pricing in the absolute worst-case scenario. Like, they're assuming that transition hits fast and hard.
Let's pause there and actually look at why this is happening, because I think a lot of people misunderstand what a modem actually represents to these tech giants.
Right. It's not just a generic chip.
Exactly. It's not just a simple piece of silicon that connects your phone to a cell tower. It is essentially a global toll road. For years, Qualcomm has owned the intellectual property toll road for 3G, 4G, and 5G connectivity.
And they charge a premium for it.
Right. They don't just sell Apple a physical chip. They require Apple to pay a licensing fee, a percentage of the entire device's value, just for the right to use that cellular technology.
Which is such a lucrative business model for Qualcomm, but you can see why Apple hates it.
Exactly. Apple isn't just swapping out a supplier to save a few pennies on manufacturing. They're trying to build their own private highway to bypass Qualcomm's entire legal and technological ecosystem.
Because that control over the hardware stack is, the ultimate prize for Apple. By removing that Qualcomm toll booth, Apple improves their profit margins per iPhone and gains total control over their internal architecture.
And for Qualcomm, losing that immense high-margin toll revenue is why the stock has plunged 20.5% over just the trailing 13 weeks. Investors hate uncertainty, but they hate a confirmed massive revenue hole even more.
They do, but here is where it gets really interesting, because the market might actually be over-extrapolating the severity of this decline.
How so?
Well, look at their immediate financial forecast. The Q4 2026 guidance still projects $9.7 billion to $10.5 billion in overall revenue.
Right.
And earnings per share are holding steady between $2.05 and $2.25. So if the sky is falling and their biggest customer is leaving, why are they still forecasting roughly $10 billion for a single quarter?
That's a fair point. But even with a resilient floor in the Android market, permanently losing half of your revenue from your biggest customer forces a reckoning. The toll road traffic is decreasing.
It is, which forces a pivot. And that brings us to their emerging growth engine, Management has planted this massive flag in the ground, targeting $40 billion in non-handset revenue by fiscal 2029.
3 years to hit $40 billion from new revenue streams. That is a monumental shift.
It's a staggering target. But the data shows the first phase of this is actually gaining severe traction. While handsets dropped 20%, their automotive semiconductor revenue absolutely exploded. It's up 61% year over year.
Okay, cars. But we aren't talking about basic, power window electronics here. What exactly is Qualcomm putting into these vehicles to drive 61% growth?
They are providing the underlying architecture for digital cockpits and advanced driver assistance systems, ADS.
Right, the smart car stuff.
Exactly. Modern vehicles are essentially rolling software platforms now, and Qualcomm is leveraging its mobile computing expertise to power the central nervous system of these vehicles.
Handling the dashboard displays, sensor processing, all that heavy lifting for semi-autonomous driving.
Precisely. And institutional investors love this automotive revenue because of the incredibly long design cycles.
High switching costs, right?
Exactly. If Qualcomm wins a contract for a 2027 vehicle platform, they are locked into that manufacturer's ecosystem for 5 to 7 years. It's highly predictable, incredibly sticky revenue.
Okay, automotive growth is undeniable great. I'll give you that. But as a valuation-aware investor, I have to do the math here. 61% growth on what is historically a much smaller segment of their business doesn't mathematically fill an apple-sized hole. Auto alone can't save them.
No, you're right. Auto won't get them to $40 billion alone. To hit that, they need explosive optionality, which leads us directly to the wild card in this report, their push into AI data centers.
No, this is the long-term growth driver everyone is watching.
Oh, absolutely. The report circles December 2026 as a critical near-term catalyst. That is the scheduled launch for Qualcomm's AI accelerator data center Silicon.
They're trying to crash the biggest party in semiconductors.
The most lucrative, capacity-constrained party in the world right now. To give you an idea of the industry tailwinds, Samsung just raised its advanced chip-making prices by up to 15% purely because of insatiable AI demand.
Okay, I get that AI silicon is the buzzword of the decade. But data centers are currently an absolute monopoly, controlled by NVIDIA's GPUs. What is Qualcomm actually going to do differently? Are they trying to beat NVIDIA at their own brute force game?
No, not at all. They are carving out a highly specific niche based on their historical DNA, which is power efficiency.
Okay, break that down for us.
So the AI compute market is split into 2 phases. First is training, feeding massive amounts of data into a model. That requires raw brute force computing power. NVIDIA completely dominates that.
Right.
But the second phase is inference. That's when you actually ask the trained AI a question and it generates an answer. Inference happens millions of times a second globally, and it requires staggering amounts of electricity.
And Qualcomm has spent the last 2 decades figuring out how to do complex computations without draining a tiny smartphone battery.
Exactly. They are taking that ultra-efficient mobile architecture and scaling it up for the data center. If they can offer hyperscalers a way to run AI models at a fraction of the energy and cooling costs, the value proposition is just massive.
It's a great narrative. But here is where I have to put my cautious hat back on and look at the actual filings.
Okay, let's hear it.
The December 2026 launch sounds amazing on a slide deck. But do we actually have any confirmed named customer design wins yet? Or is this just management selling us a beautiful dream? Are the Amazons and Microsofts actually lining up to buy these chips?
Honestly, based strictly on the filings, no. There are no confirmed named customer design wins disclosed yet.
So it's completely unproven.
It is currently a scheduled product launch, not a confirmed revenue stream. That's why that December 2026 window is the ultimate moment of truth. Without named customers, this massive AI pivot remains a theoretical exercise.
Which forces us to look past the top-line narrative and dig into the actual business quality and cash flows. Because if the future depends on a product that hasn't sold yet, we need to know exactly how healthy the core business really is today.
And the financial data from the 9 months ending June 2026 has a massive divergence. It's actually kind of jarring.
It seriously gave me a pause. Let's walk through it. For that 9-month period, reported net income increased by a very impressive 43%.
Hitting $12.377 billion.
Which sounds fantastic, right?
It sounds like the business is firing on all cylinders. Until you look at the operating cash flow over that exact same period.
Which actually declined by 16%.
Dropping down to $8.405 billion. This is a massive red flag for capital protection. How does a company report a 43% profit spike while the actual cash entering the bank drops 16%?
It points directly to non-cash or one-time gains, artificially inflating the income statement. It's an accounting anomaly.
It's an illusion. It's like bragging that your net worth skyrocketed because Zillow says your house doubled in value, but your actual checking account is overdrawn. The paper gains look amazing, but cash flow is a reality.
And that 16% drop in cash flow aligns much more closely with the 20% drop in handset revenue.
Exactly. Now, to be fair, what are the actual sustainable margins? Well, if we isolate Q3 standalone, the net margins were 20.1%. And that perfectly matches the trailing 12-month average of 21.01%. So the underlying sustainable business is generating roughly a 20% margin.
Which is still solid, but it's not the massive 43% growth narrative the headline implies. And unfortunately, deteriorating cash flow isn't the only thing that could go wrong here. Sitting right in the middle of this entire roadmap is a massive legal landmine.
The ARM lawsuit.
Yes, the ARM litigation is a severe binary risk. ARM is suing Qualcomm, threatening their legal right to use a CPU architecture called Orion.
And Orion isn't just a side project. It is the foundational blueprint for all of their next-generation products, automotive, PCs, and those AI data centers we just talked about.
Wait, so where did Orion actually come from? Didn't they buy a startup for this?
They did. In 2021, Qualcomm bought a startup called Nuvia for $1.4 billion. Nuvia had a highly coveted license from ARM to build custom server chips. Qualcomm took Nuvia's brilliant engineering team and used their designs to build Orion.
And now ARM is arguing that the specific license they granted to Nuvia didn't legally transfer over to Qualcomm when they acquired them.
Precisely. ARM claims Qualcomm is using their foundational IP without paying the right licensing fees. They want to rip up the contract entirely. If the judge sides with ARM and issues an injunction, Qualcomm's ability to legally sell anything with an Orion core could be halted globally.
Which strikes right at the heart of the entire long-term growth thesis.
Yeah.
If they lose Orion, they lose the auto roadmap. They lose the AI data center launch.
It would force them to either negotiate incredibly punishing financial settlements, which would destroy their margins, or attempt to pivot to alternative architectures, which would take years of engineering that they simply don't have.
So for you listening, think about what that means for your wealth-building strategy. How comfortable are you investing capital where the entire growth narrative could be erased by a single judge's ruling on a patent dispute?
It's an incredibly heavy risk profile, which brings us to the sentiment check. How is Wall Street actually trading this setup right now?
Well, looking at the technicals, the anxiety is obvious. The stock is trapped at $161.91, which is well below its 50-day moving average of $180.03, and failing to break its 200-day average of $167.44.
So it's in a volatile phase with no confirmation of a trend reversal.
Right. And more telling in the charts is the insider behavior. According to the data, there were 0 open market purchases by insiders recently. None.
But there were sales, right?
Yes. 28 insider sales totaling 10,700 shares. Now, 10,000 shares is a tiny fraction for a company this size. But the complete absence of insider buying when the stock is down nearly 40% is a glaring signal to me.
The insiders are sitting on their hands, but the institutional smart money is actually making moves. We have a fascinating data point here. The major hedge fund Viking Global Investors just established a massive new stake of 1.5 million shares.
1.5 million shares. Viking Global doesn't just throw darts blindly. They clearly see a path through the Apple cliff and the ARM lawsuit.
They do. They're looking at that compressed 18.6x PE valuation and modeling out a highly optimistic 3 to 5 year blue sky scenario.
Okay, let's logically map out what that blue sky scenario looks like.
Yeah.
Because several major dominoes have to fall perfectly for this business to compound shareholder value at that level. Step 1 obviously has to be the lawsuit.
Right. The legal threat has to disappear, either through a manageable settlement or a definitive legal win, presuming Orion.
And once that foundation is secure, the second domino is the existing engine managing the Apple transition. The bleeding has to be a slow fade, not a sudden drop, preserving cash flow.
Exactly. Which gives the third domino, automotive, time to compound. That 61% growth has to evolve into a massive foundational pillar, proving they are the undisputed leader in smart vehicles.
And the final long-term catalyst.
December 2026. The AI data center launch doesn't just happen on time. It secures major, named hyperscaler clients. They capture a real slice of the massive AI inference market.
So if they win the lawsuit, manage the Apple decline, dominate auto, and crash the AI data center party, what does this business become in 3 to 5 years?
The entire narrative shifts. The market stops pricing it as a dying modem maker and starts valuing it as a diversified, high-growth AI and auto tech platform. Average analyst price targets for that specific blue sky scenario cluster around $203.
which is substantial upside from $161.
Mhm.
But remember, this is an optimistic scenario, not a prediction. The base case reality right now is that Qualcomm is navigating one of the most difficult transitional periods in its history.
It is. Handset revenue is shrinking, and the new segments just can't fully offset the massive Apple headwinds in the near term. That's why the overall investment rating in the report is a 5 neutral with a constructive tilt.
So the wealth-building verdict here requires patience and caution. The strongest long-term driver is undeniably that highly efficient AI inference silicon and the sticky auto contracts. But the biggest threat is the binary ARM lawsuit and the immediate cash flow deterioration from the Apple cliff.
The next 6 to 12 months are the absolute crucible. We're watching Q4 earnings for cash flow stability and that December 2026 AI launch.
Before we wrap up, just another quick reminder that if you want to dig into these metrics yourself, you can grab that 14-day trial to StockOracle in the description. But always do your own due diligence.
Absolutely.
And as you watch this story unfold, I want to leave you with one final provocative thought to mull over. We've talked extensively about this AI data center launch being their golden ticket. But what if the launch happens? The product is technically brilliant and incredibly power efficient, but the hyperscalers are simply too locked into NVIDIA's software ecosystem to switch.
Oh, the vendor lock-in problem.
Exactly. If they build the world's most efficient AI chip and nobody buys it because it's too hard to port their software over, does Qualcomm permanently lose its chance to join the AI revolution? And if they miss that train, are they trapped forever as just a highly profitable relic of the smartphone era?